All right. Welcome, everybody, to the next edition of the Virtual Time Series seminar. Today, we are very happy to have Andrew Patton joining us and Nikolaus Hautsch as his panelist or discussant. Andrew's going to talk about bespoke realized volatility. Andrew, a pleasure. You have 1 hour. And you're muted still, Andrew.
Thank you very much for the invitation. I'm happy to be here and presenting it. And I wanted to say congratulations to the organizers of this series. I know running these things takes a bit of work, but it's a real benefit to people all around the world. But juggling time zones, especially when the clocks are changing. I know US just moved to daylight saving, and I remember that is a juggle. So well done for everybody for getting the times right. Okay, let me present this paper. This is joint work with a former PhD student of mine, Hautsch, who's finished his PhD and he's now working for a hedge fund in New York. This was his last chapter. Okay, so the background for this is building on it's in the realized volatility literature of some sort. So for those of you who are not as familiar with it as some others, a quick recap of what realized volatility is. Realized volatility is a measure of volatility at a lower frequency using data at a higher frequency. That's the short story of it. And so the classic sort of measure for this is summing up squared 5-minute returns over a day. So we get a measure of the day's volatility using 5-minute returns within that day. And we have M such returns. So in New York, that corresponds to 78 5-minute returns. And we get this measure here, RV. So this thing had been studied in the probability and stochastic processes literature 10 years before econometricians discovered it or adopted it. And then it was studied, its empirical properties were studied intensively starting in the early noughts. So Anderson, Boleslav, Diebold, Lebis, Barnolf, Nielsen, Shepard, and others studied this in 2001, 2, 3, looking at this measure, its consistency and asymptotic normality, under which conditions these results can be obtained. And then following that was a burst of research on improving this measure of volatility. So making it more efficient, making it robust to jumps. And these little adaptations down here, this is Barnolf, Nielsen, and Shepard, Mancini, Anderson, Dobrev, and Schomburg. And then robust to market microstructure effects like bid-ask bounce, stale prices, other things like that. So there's been a lot of interesting work done on realized volatility, a lot of interesting extensions done. What they have in common is that they think about this as an estimation problem without thinking about where that estimate's going to be used. And so that's where this paper deviates from the existing work. We're going to pay explicit attention to where the realized volatility measure will be used. So as an applied researcher, done some work in volatility forecasting, I would say 80%, possibly more applications of realized volatility are in forecasting models. So the estimate is taken, plugged into some sort of model and used to get better forecasts of volatility, to make better investment decisions, better trading strategies. The types of models they're plugged into are models like the Garch-X model of Engel 2002. So this is a Garch model, but where you swap out the lag squared return for the realized volatility. The heavy model of Shepard and the realized Garch model are two similar models that are directly linking returns and volatility. And then the Ha model of Corsi in 2009. And that's the model I'm going to focus most of the talk on. So our question is, if we know that we're going to take this measure of volatility and plug it in to a specific forecasting model for a specific variable with a specific forecast horizon, can we do better in constructing that measure of volatility? Can we tailor it to improve its performance? And that leads us to what we're calling bespoke realized volatility. So that's what I'm going to talk about today. And I should say I've got all the little head icons closed on my screen so that I can see my slides. So please feel free to jump in and interrupt me at any time. Hautsch and I are working on a revision of this paper right now. We think we've almost finished the revision. Whether that's true depends on what happens in the next 60 to 90 minutes. I welcome any questions you might have, and please just jump in and ask. Okay, so what we're going to do is we're going to suggest a way of tailoring the construction of a realized measure of volatility to improve its usefulness in a forecasting model. What it ends up doing is leading to a ton of extra parameters that have to be estimated. We use machine learning methods to overcome that hurdle. Pretty standard machine learning methods by now. with the takeover of machine learning in econometrics. Mainly, though, this is an empirical paper. So we study every stock that was ever in the S&P 500 index over this 25-year period. It gives us a total of 886 firms. And I'm going to show you tons of evidence that the tailoring that we propose, the bespoke RV that we're constructing, significantly improves forecast performance. Along the way, we have a cheeky little time of day adjusted realized variance, which you can get almost for free, and it works significantly better also than standard RV. And then we will drill in a little bit and figure out, why is this measure working better? How is it working measure? And we isolate two in channels for its improvement. One is that it's more timely. It's adapting to changes in market conditions more quickly than standard RV. And another is that it's taking advantage of information that's more available at different times of the day. And that'll become very clear by the end of the talk. Okay, so I have about 50 odd minutes left. I'll briefly just link to the literature. So we link to 4 broad strands of the econometrics literature. Most obviously, volatility forecasting with high frequency data. And that literature is so large that I'm only listing surveys because there's just hundreds and hundreds of papers in that area. We link broadly to the machine learning in economics and finance literature. And I've got a couple of survey papers of that here, and then a couple of specific finance papers listed there as well. So this is gathering more attention broadly in econometrics and finance. It's also got attention in the specific problem that we're focusing on, which is volatility forecasting. And there are some papers down here. You can see all of those dates are pretty recent, and a lot of them are still working papers. So this is a very early literature. One of the papers here is actually by the panelist Nikolaus Hautsch. And then lastly, when I come to interpreting how bespoke realized variance is improving on standard realized variance, we end up linking to an older literature on market microstructure effects. And you'll see some of that later. Okay, so here's the outline. I'm going to introduce the measure, talk about how much tailoring we allow for. And that basically comes down to how flexible we want to be, how many parameters we want to estimate. And then I'll show you the empirical results, the basic baseline results, drilling into where the gains come from, and then a couple of extensions. And these extensions that I'm going to show you, I don't think are in the version that's online. We've been working on this revision for about a year. And I'll try to show you a couple of the more interesting ones we've done. Okay, so the whole idea of bespoke realized variance is that you need to know the model in which the realized variance measure, the volatility measure, is going to be used. So you have to take a stand on what model we're going to use. So for most of the paper, we're going to adopt this heterogeneous autoregressive model, or Fulvio-Corsi from 2009. That model is very widely used in volatility forecasting, partly because it's so simple to estimate. So the equation up here in red has a notation that I need to explain. So we're forecasting day T realized variance with day T minus 1 realized variance, the average of realized variance from days T minus 2 to T minus 5. So this is like the weekly average variance, but not including yesterday. And then the average realized variance from day 6 to T minus 6 to T minus 21. This is the monthly average realized variance, but excluding the first week. So I make these 3 terms non-overlapping. Of course, that doesn't change the fit. This just makes the parameters a little easier to interpret. So this model has been used in a ton of different papers. It is not the best model out there. And indeed, you can make a very good living by proposing improvements of it. Sort of, that's what we're doing in this paper. But it's a very good benchmark model. And so we're going to start from that model. You can see that it is an AR21, but with restrictions on the AR parameters. So there's only 4 free parameters rather than 22. And the RV measure we're going to use throughout the paper is 5-minute realized variance. So we're going to take 5-minute returns on stocks from the TAQ, the Trades and Quotes database, and the New York Stock Exchange. New York Stock Exchange is open from 9:30 to 4, so that gives us 78 5-minute periods per day. And we're only looking at the intraday variance. So we're looking from 9:30 to 4 and not including the overnight. The overnight is very important, but it has different dynamic properties to the intraday variance. And so we're going to leave that aside and just focus on the intraday stuff. When I present this, one question I get, if not now, I certainly get at the end, so let me answer it in advance, is what about tailoring the number of observations you use? Is 5-minute the best sampling frequency? Is calendar time sampling the best choice of sampling? One could use business time sampling instead. These are great questions, and they're not something we've addressed. So we are sticking with this as our raw input, and then we're going to do some other things. So those other ideas are interesting. And if Hautsch was a third-year PhD student, not a 1 year out from his PhD completed student, former student, we'd be doing it right now. Okay, so I'm going to show you 3.5 sort of models where we tailor the realized variance to the problem. The first one we're going to consider is the most flexible one, and that is where we recognize that we have 21 lags of daily realized variance on the right-hand side, and each one of those 21 lags contains 78 5-minute returns. So the most flexible thing one could do is just give each of those lagged squared 5-minute returns its own free parameter. So this is just a huge model where each one of those could matter differently from the other. It leads to a total of about 1,600 free parameters. But it's still just a linear model. This could, if you have sufficient data, this could be estimated by OLS if you wanted to do that. Of course, that's going to be a bad idea because there'd be a ton of estimation error. One could do that. We are going to use instead an estimation method from the machine learning literature. This is stochastic gradient descent as one way of shrinking the parameters. We're going to consider some other methods as well, but for this model, we use mostly this stochastic gradient descent, which I'll talk a little bit about later. So this is the completely flexible approach. You can already guess, as sensible people, this is not going to work very well to produce out-of-sample forecasts. So you know this is a bad idea. I agree. Well, the reason we keep it in the paper is that we want to show how badly the most flexible thing does, and then work our way inwards to a more sensible, more structured model. So this is sort of the end point, the most flexible, and then we're going to put some more structure on it. So a sensible way to impose some structure on that previous model is to impose the Haar structure. So the Haar model is very popular for a reason. It provides a good fit to data in a range of different applications. So this sort of decomposition of 21 days lags into yesterday, last week, and last month turns out to be empirically very successful. So what we're going to think about here is we impose that structure. So we only have 3 things on the right-hand side, but we allow each one of them to have their own free weights. So we're going to weight within the first lag, each of those 78 returns flexibly. In lags 2 to 5, they're going to have their own set of weights, potentially different from the weights for the daily. And then same for the month. So this gives us a total of 235 parameters, still a big model, but much smaller than the 1,600 or so parameters of the other model. And again, we're going to think about how do we impose some shrinkage of some sort to reduce the amount of estimation error. So this is the second type of bespoke RV. Now let me preview some results that I'm going to show you in more detail later to motivate the third model. These are the optimal weights from that flexible Haar model as a function of the time of day. So I apologize if the font is a little small. This is ranging from 9:30, so the first 5-minute period, to 4 o'clock in the afternoon. The flat line is the weights that come from the baseline Haar. So they have equal weights because they're using standard realized variance on the right-hand side. So every realized variance has the same weight. And it's multiplied by that parameter beta D, which turns out to be about 0.45 or something. So the implicit weights across the day for the standard Haar is this horizontal line here. The red line is what we get if we estimate the weights using one of the methods I'll talk about later. You can sort of see there's a pattern in this red line. Ignore for now this inverse hump shape. I'm going to talk about that in a second. Just the flat line and the red line. The red line, you can see there's a pattern there, but you can also see a lot of zigzagging, right? And that is probably not true. That's probably just estimation error. We don't really think that adjacent 5-minute periods have differing importance for prediction from a effective coefficient of 0.6 to an effective coefficient of 0.4. Maybe it's true, but it looks to me more like estimation error. So the third bespoke RV we're going to consider is one where we impose some smoothness on the weights across the trade day. So we're going to do that using a simple cubic spline with nodes either at half-hour or hourly intervals. So this basically determines how wiggly the line can be. So with half-hourly intervals, we have 13 per day. Hourly intervals, we have 7 nodes per day. And then we estimate the height of that function at each of those nodes and cubic interpolation between them. So this leads to a model with 22 or 40 parameters. So we're sort of coming down from 1600 to 230 or so to 40 to 22. And the baseline model, I should remind you, is just 4 parameters. Now, the last model I want to talk about is a model that's not really in the class of bespoke realized variance type models, but it's a model that I thought was an obvious one for a referee or an editor to ask us about. And I wanted to make sure we could beat this as well as the baseline model. So this better baseline model is motivated by 2 facts. The first one is an empirical finding, which is that volatility varies deterministically over the trade day. So this is using data on the SPY, a tracker for the S&P 500 index. Volatility is high at the open, low around lunchtime, and rises again in the afternoon. This is very common. It's true for every US stock I've looked at. It's different in Europe and Asia because there's overlaps with other markets opening, but in the US, this U-shaped pattern is very common. And what's also interesting and important to note is that the scale of the y-axis is about a factor of 2. So for this particular asset, it opens at about 15 or 16% annualized volatility. Lunch volatility is about 8%. So that's a big variation. Volatility halving or doubling over the trade day. That's a lot. This is well known. This is not news. This is the first part of the motivation for this other estimator. So this is the first bullet point up here. The second motivation is that we know from econometric theory, either in traditional long span theory or high frequency infill asymptotic theory, variance is estimated with more error when the level of the variance is high. So let me say that again. When the variance is high, it's harder to estimate. This is true in cross-sectional data, time series data, high frequency data. This is just and this is the sort of the standard result for long span asymptotics. So the asymptotic variance is twice the level of the variance squared, so the sigma to the 4. This motivates, to us at least, a different way of reweighting the high frequency returns, where we're going to call this the time of day realized variance. So we reweight the 5-minute squared returns by the average variance for that 5-minute window. So this sigma I squared is the picture we got on the previous slide, but we're going to invert that so that each one of these has roughly equal variance, equal contribution to the realized volatility measure. Effectively, if I go back a slide, what it's going to do, it's going to end up with weights that look like the inverse of this function. So it's going to downweight information at the open, upweight lunch information because it's the least volatile, and then downweight the close. So this is not in the class of bespoke realized variance because it's not tailored to any model. This is motivated by an empirical pattern and a theoretical pattern. The volatility has a diurnal pattern, and theoretically, volatility is harder to estimate when it's high. So this is not in the class of estimators we're trying to market, but I think it's an easy one to compute, and it's in the same spirit as what we're talking about. So I wanted to include it in the set of things that we're looking at. So this, to summarize, these are the models I'm going to discuss. So we have the baseline HAR, this time of day HAR, which is the same model, but with the time of day weights. One where we allow a cubic spline to interpolate, more flexible, a completely flexible weights, but still imposing that HAR structure. And then finally, that fully flexible model with 1,600 or so parameters. Okay. So we use a standard split sample technique to estimate and tune the hyperparameters. So 60% for estimation, next 20% to tune the hyperparameters of the estimation method. And then the last 20% is the untouched, that's the outer sample period for forecast comparison. We estimate the standard HAR and the HAR with the time of day weights just by OLS. There's no tuning parameters there, so this is nothing. The more flexible models need to be estimated somehow, and the way we do it is we use this mini batch gradient descent algorithm with a gradually decreasing learning rate. So it's a way of sort of choking off overfitting in sample so that hopefully you get better fit out of sample. I think in the interest of time, I'm going to skip all these details, but they're in the paper, and these are the variations that we consider. So I think in the end, we have 72 different effective estimation methods and how much we shrink the parameters. And then we choose that in the validation sample, and we use that to get the outer sample forecast. So we use a ton of parallel processing for this, and because we've got 880 odd stocks, this is very easy to parallelize. You just send one stock to one node, another stock to another node, and keep doing it until they're all done. In the end, the whole thing takes about 8 hours to run, if you have sufficient cores to do all the jobs in parallel. Now I'm going to summarize the results using de Bob-Mariano tests to compare the out-of-sample losses from the forecasts. The results I'm going to show you here focus on Q-like loss. We have some results for mean squared error in the paper. Those are broadly in the same direction, but just a lot lower power. And I'm doing an overall summary across all of the stocks using a panel de Bob-Mariano test. And that's just trying to summarize 880 individual tests into a single number.
Andrew, could I ask a quick question?
Yes, please.
So the fully flexible model can be estimated in a ton of different ways using penalization. Is there like, I mean, you're choosing sort of like a more structured form of like thinking about actually what type of restrictions would be useful. But have you considered like sort of more standard penalized estimation methods there as well?
This is a good question. So I think on the very next slide, I'm going to talk about that. So
okay,
it's perfect time. Good. Though I have to confess, we don't try all these different methods on the fully flexible model. But that model we thought was going to do bad no matter how we regularized it. So but we do it on the so-called flexible HAR, which has like 240 parameters. So one of the things we do is this stochastic gradient descent. The other things we do are the more classic regularization methods. So we have the general formula is up here. If this alpha parameter is 0, then we're shutting down all the penalties. So this is just OLS. We consider ridge regression, lasso, and elastic net, which has a little bit of both L1 and L2 penalties. And I should say here, something that's changed from the draft online to the new version that's about to come out. In the draft online, I think we were shrinking the parameters towards 0. And then what we sort of realized in the process of presenting it and revising the paper, we really should shrink towards the baseline HAR parameters. So this more flexible model, we're going to shrink towards that. We're going to shrink towards the baseline HAR, not towards 0. This is not hard to implement. It just is a more sensible target when you've got such a good baseline model. Okay, this is perfect. So now get into the meat empirical results. So the sample period is from 95 to 2019. We have about 1,200 days for the test sample, which is our out of sample period, 886 firms. We wanted to tie our hands a little bit there. So we just said every stock that was ever in the SP 500 index in this period is in our sample. So firstly, a few pictures, and then we'll get to the tables. So this here, and this was as big as I could make it and still have it fit in this slide here. These are the optimal weights from this fully flexible HAR model, this one with 1,600 parameters. And the way I'm plotting it is from 3:55 to 4 o'clock yesterday, going back in time to 9:30 yesterday. And then the shaded bars are all indicating that it becomes 2 days ago. So this is 4 o'clock 2 days ago to 9:30 2 days ago, 4 o'clock 3 days ago to 9:30 3 days ago, all the way out to 9:30 21 days ago. There are 3 lines here. So the red line is the step function, which comes from the baseline HAR model, where the intraday 5-minute returns are always equal weighted. So it's always a step. And then the height of the step corresponds to the coefficient in the model. Beta D is here. This is beta W, and this is beta M. The repeating hump shape patterns here, this is from the time of day model. So where we use simply the inverse of the average volatility pattern per stock. So we're not doing this just using the SPY picture that I showed you earlier. For each stock, we estimate its own U-shaped pattern in the testing sample, not in the outer sample. And then we use the weights implied by inverting that to get the time of day realized variance. So we get a bigger U shape here because the coefficient on the first lag is large. We get 4 repeats of that here in the lags 2 to 5, and then we get another 16 of those for the monthly. And then the solid black line, which you can barely see is solid, it starts here, it goes down across day T-1, so from 4 o'clock down to 9:30, and then it drops here, and then it goes down here. mainly what I see from this is just a lot of jiggles, which is estimation error, which is of course going to lead to worse forecast performance. And I should say we tried very hard to get this fully flexible model to work. So it's going to end up not working, but I need to try to convince you, at least try to tell you, we did our very best to try to tune this model to get it to work. You know, the idea of machine learning is you just throw computing power at the problem, extract the signal, and you get a beautiful forecast. That sometimes works, but in economic and financial applications where the signal to noise ratio is low, and where we have, even with this high frequency data, it's still limited sample sizes, it doesn't always work. Just throwing computing power at the problem doesn't always lead to a great answer. This result, now I'm going to show you the results from the flexible HAR model, where I only estimate flexible weights for the daily, weekly, and monthly. I don't do each day separately. This is the same picture I showed you earlier. We have the HAR weight is about 0.45. The inverse time of day weight is this U shape here. And the red line is the flexible weights, where each 5-minute period gets its own parameter and it's estimated flexibly. I should say also, I'm going to show you some more pictures like this. And this picture is an average across the 886 stocks. So we have one of these pictures for each of the stocks. I'm just showing you the average across all of them so that you can sort of see roughly what's going on. So I said earlier that this slide motivated imposing some structure through a cubic spline. And so I'm going to show you that later. Let me show you the weekly weights here in green. And let me just flash forward to the monthly weights. So you can see there's a lot of jumping around in the green line. And a question I have been asked in seminars before, is the green line different from flat? And is it different from this inverse U shape, the time of day type weights? Similarly, the monthly weights, a lot of jiggles and basically just bouncing around this straight line. So I am going to answer that question, but I'm going to answer it through their forecast performance. So one of the people asking me this question was interested in seeing confidence intervals around these optimal weights. So we could, in theory, produce those, but I'm not interested in the weights themselves as such. What I'm interested in is getting a better forecast. So the way I'm going to determine whether this blue line is different from flat or different from inverse U shape is through the forecast performance. And that's coming, so I will show you that soon. And now some pictures where we have a cubic spline. So this is the daily shape. So we see that it starts off low. It almost tracks very nicely the time of day weights until about lunchtime. Now, the cubic spline has no idea what time of day it is. It doesn't know that volatility tends to be high in the morning and low at lunch. This is just coming out of the data. So this is the signal extraction problem that you can get when you throw enough computing power resources at the problem. After lunch, though, they deviate, and they deviate most strongly in the last couple of hours of the trade day. So where the time of day weights are declining because volatility tends to go up at the end of the day. So when you downweight that, it ends up coming back down. Here, when we estimate the optimal weights directly from the data, we see it goes up massively compared with the other methods. So we're going to drill into that a little bit later. The weekly weights here in green, I would say look pretty similar to time of day. And in fact, I think in the appendix, we're going to tell you the answer there. The green weights basically are not different from simple time of day weights, but they are slightly different from flat. And the monthly weights essentially are flat. But now the beauty, of course, of the cubic spline is we crush those zigzags. So we're getting rid of some of the estimation error that would be there otherwise. Okay, so this is our main table. This is the biggest table I'm going to show you. I'm going to walk through it slowly, highlight what's coming out. So what we're doing here, we're doing pairwise comparisons of models. I have the HAR, which is our benchmark model with standard plain vanilla realized variance as an input against these competing models. I realize now I haven't clarified something which is an important point. I'd like to pull up the equation so I can show you it. Let me just use this equation to emphasize. Throughout the paper, what we're doing is altering the inputs to the forecasting model by tailoring the weights applied to 5-minute returns, doing some other tricks. The target variable, though, always remains the same. It's always plain vanilla realized variance. So we're not changing the target and changing the predictors. The target is left as plain vanilla realized variance. That's what we care about. We care about the variance of returns without any funny weighting. But just because that's what we care about doesn't mean that's what we have to put inside the model too. That's kind of the point of this bespoke idea. So we're messing with the ingredients in the model, but we're not messing with the target variable. So that's always the same. Okay, now let me show you this table of results. Okay, so HAR versus fully flexible. It wins 789 times. 489 of those are significant at the 5% level. So this is across the 886, I think, firms. It loses 97. So in a big sample, it'll win and it'll lose some, like this. Even the best model is not going to win 100% of the time. It doesn't lose many significantly, only 25. And when I summarize this whole panel of losses across all out of sample days and all firms, I get a t-stat of minus 24. Now, this is a standard t-statistic. So the relevant critical values are plus or minus 1.96. So this is not a different distribution. This is a normal under the null, very strongly rejecting the null, that these have equal forecast performance, and rejecting in the direction of the HAR model. It has lower out of sample loss. So this fully flexible idea, if you were an eager adopter of machine learning and said, I'm just going to take a model, ton of parameters, estimate, let's see what comes out, it does terribly, even when you try very hard on the estimation method. This very simple, almost free time of day adjustment on realized variance significantly beats the standard HAR. So using the inverse time of day volatility as the weights leads to 675 wins compared with 211 losses in the pairwise comparisons, and a panel t-statistic of almost 17. So this thing you can get for free. It takes no computing power, basically, and it takes almost no time. The cubic HAR, which is the model that we're going to adopt as our favorite until the very end, and then I'll show you one that is just a tiny bit better and a ton easier. The cubic HAR here performs the best. It has the most wins in the head-to-head comparisons, not the largest t-stat, but a t-stat of 15 versus a t-stat of 16. We're way in the tail. We're rejecting the null. One thing that's interesting here, and I don't have a great answer for it, but it relates to Geert's question earlier, is different ways of regularizing the model can affect the out-of-sample forecast performance. So in the top line here, we're regularizing through this stochastic gradient descent estimation method. So it's an implicit regularization. Down here, we're considering 3 standard regularization methods, ridge, lasso, and elastic net. So if you use this stochastic gradient descent type method, it outperforms baseline HAR. Not as well as the cubic HAR, because it's still got those zigzags in it, but it is significant. So it is capturing something, and the increased estimation error is offset by the increased signal that it's able to extract from the data. But if you use standard regularization methods, and these are tuned, where we considered a bunch of different ridge penalties and lasso penalties and combinations for elastic net, we weren't able to beat HAR. HAR wins quite strongly against any of these ways. So this was the first time I had seen such very different results from one regularization method to the other. I'm not a regularization estimation expert, but this is a sign switch, and not only a sign, but a significant switch from significant positive to significant negative. And I'm putting it out there for someone who is interested in thinking about that problem. I'm going to show you one table where I just change what I'm comparing all the other models to. So then when I switch it to this cubic HAR, we see that it significantly beats all of the competitors. So it significantly beats time of day, which was probably its closest competitor in the previous table, if you had to guess. It beats the flexible HAR. So this is a sign that imposing the cubic spline helps. Of course, it puts more structure on the model, so it can't extract as much signal, but it's eliminating some of those wiggles. So it eliminates some estimation error and turns out to improve forecast performance. Okay. So now I want to talk about why. I want to try to think about why this might be improving. So we think there's 2 possible channels. The first one is the responsiveness of the forecast. And the idea is that, and this actually relates to the regular Hautsch model versus a Hautsch X type model, where the extra variable is realized variance. When you have a better measure of the current volatility, the model is able to attach to it a larger coefficient because it's a better signal of what's happening today, and it's contaminated with less estimation error. And so other things equal, larger parameters on this measure is consistent with that measure being a better measure of what's happening today. So it leads to more responsive forecasts because it's able to put more weight on more recent information. So let me show you a very simple way of doing that comparison. In fact, I think this slide is what I mostly just said. So let me show you the table of results here. So the baseline model is the second row here. Its weights averaged across all the stocks was 0.44 on the daily, 0.3 on the weekly, 0.23 on the monthly. When we use the fully flexible model, which had a lot of estimation error, it ends up sort of smoothing out the weight. So this HAR model has most weight on the daily, next most weekly, and next most monthly, consistent with volatility being more predictable using more recent information. It doesn't have strong seasonality. So yesterday usually is the most relevant piece of data. With the fully flexible model, it is too noisy, and so it ends up putting lower coefficients on all of them. In the cubic HAR, which is the preferred model, and it's basically the same as TOD in this table, so I'm not going to make a big fuss, it puts more weight on the first lag, equal weight on the weekly, and less weight on the monthly. So it's able to move some of the weight to the more recent end of those 21 days, which allows the model to react to changes in market conditions more quickly. Now, the other thing, and I think the more obvious way that this model differs from the baseline model is in the weights that it attaches to the different 5-minute periods. The green weights and the blue weights, maybe the green is different from flat. And we have a little bit of evidence that it is. The blue is basically flat. The big change over here is the left panel, which I've drawn with the little arrow. This is where we're seeing something going on. So zooming in on that, the question is, what's going on at the end of the day? It's basically time of day weights at the beginning, but it goes up a lot towards the end. So our conjecture is that this is an information channel, and that is that the afternoon of the daily lag, this is yesterday afternoon relative to the target variable today. Yesterday afternoon is the part of the prediction sample that's closest to the target variable. So if volatility is persistent, it is conceivable that it links more closely to the afternoon than the morning, because the morning is 6 hours older than the afternoon. So we're going to test this by looking at how the weights change as we go from 1-step forecast, which is what I've shown you throughout so far, to 2-step all the way up to 5-step. So if it's proximity to the target variable, then this big spike up in the afternoon should attenuate as we go to longer and longer forecast horizons. And this is what we see. So the red line is the same shape I showed you earlier. I notice now that it's got a slightly different pattern to the picture I just showed you. This is version control issues. We've updated the estimation method slightly, so we're getting slightly different images out. So the red line is what I showed you earlier. It tracks time of day to the first half, and then it shoots up in the afternoon. The solid black line is the 2-day ahead forecast. Dashed line is 3, dot dash is 4, and dotted is 5-day ahead. So each one of these lines was a massive amount of work to obtain. I'm showing it, just flashing it in one picture, but it answers the question of, is it proximity to the target variable? And the answer we think is yes. In fact, the results come out even cleaner than we could have hoped. The afternoon effect, if you can call it that, is monotonically declining in the forecast horizon. Now, I would have been happy with a little bit of non-monotonicity, but we go from 1 step ahead, 2 step ahead, 3 step ahead, 4 step ahead, 5 step ahead. So as the target variable gets further away, the difference between being in the afternoon of day t-1 and the morning of day t-1 matters less and less. And that's what we're detecting here. When we look at the weights for the weekly lag and the monthly lag, we don't see too much. Roughly what we see is that the weights go up a little bit, and this is just allowing for more smoothing. Because it's so far in the future, it's just smoothing out the information from the prediction sample. Okay, and then what I want to show you now is some extensions that we've done. I think the first of these was in the paper, the other two I think are new. Okay, so one of the questions I got, and I got it from my colleague and good friend, Tim Boleslev, when I presented this, Hautsch presented this in a brown bag, was seems like you're doing a lot of work on the HAR model. What about some other models? There are other volatility models out there. And so we took the hint that maybe Tim was asking about the Hautsch model. And so we've extended it to the Hautsch model to see what happens. So what we're looking at here is a bespoke Hautsch model. So to remind you what that model is, we have daily returns. This is the square root of the variance times some shock. We have the Hautsch type equation here in the second line. The usual Hautsch model would have RT minus 1 squared as the last variable. We swap that for realized variance at T minus 1. And then we consider tailoring the realized variance, the weights of the 5-minute returns inside that thing, to see whether it improves forecast performance. So it's a totally different model. It's no longer just a linear regression type model. This is a recursive model. It has to be estimated with a loop inside it, so it's a little slower to estimate. Not a big deal. It's just we're outside the class of HAR models here. So I'm addressing Tim's question on, do we have anything to say about models outside of the class of HAR models? And this is what we get. So in the sort of pink dashed line is the weights from the HAR model that I showed you earlier, just to keep in the back of your mind. And the red line here are the weights that we get when you're taking the realized variance and plugging it into a Hautsch model. Roughly what we see is the same pattern. So it starts off low, consistent with this time of day type effect. It rises through the day and then it finishes up high. So roughly the same story as before. I'm going to show you in a second that it also beats the baseline Hautsch model. One thing you might note is that this red line is a little more wiggly than the pink dashed line. And we think what's going on there is that when we try to estimate the weights in this bespoke RV inside the Hautsch model, if I go back for a slide, the target variable here effectively is the squared daily return. So when you optimize the Q-like for this problem, the target variable is not realized variance as it is in the HAR model. It's the squared daily return, which is a noisier measure of volatility. So this is a more challenging estimation problem because our target variable has more estimation error in it as a measure of that day's volatility. So our thinking is that the reason this red line jiggles around a bit more is that we have more error in the model coming from this worse volatility proxy. And one of the things we're doing in the revision is doing this Hautsch model, but changing the target variable to be the realized variance. So comparing the models here, so I have the model we're looking at is the Hautsch model. The baseline is standard RV inside it versus bespoke RV. We significantly beat it. We have lower out of sample loss. The time of day version also significantly beats. Sorry, let me get the other way. The time of day is also significantly beaten by the bespoke version. So this is a better benchmark model. We don't beat it as strongly, but relative to a critical value of 2, we still significantly reject the null in favor of bespoke Hautsch. So consistent with the idea that if you know you're going to take this measure and plug it into a specific model, you can do better by tailoring that measure for that purpose. Now we go back a little bit to the HAR family of models, but to successful extensions of that model, I'm going to consider just 2 of them. One is what's now called, I don't think these authors called it that, but the continuous HAR. So this is Anderson, Boleslev, and Diebold, if I remember correctly. They note that the component of realized variance that comes from the continuous return is more persistent than the component that's coming from the jump return. So if you decompose high frequency returns, we can get this decomposition quite cleanly, both in theory and practically it works well too. We decompose returns into a continuous part and a jump part. So it turns out the sum of squared jump parts is almost unpredictable, but the sum of squared continuous parts is more predictable than standard RV. So the one measure of the continuous variation is this bipower variation proposed by Barnoff, Nielsen, and Shepard. So it is the sum of absolute 5-minute returns multiplied by their lead or lag. So rather than take the squared return, we use 1 period lead or lag of this thing. This pi over 2 is an adjustment to make sure that it's centered on the right quantity. So the pi comes from the fact that at high frequencies, well, the continuous return is normally distributed. It's coming from the Brownian motion increment. So we're going to take this continuous half, which still has the target variable as realized variance, just as it's been throughout the HAR applications. But the continuous HAR swaps on the right-hand side lags of realized variance for lags of this bipower variation measure. And we're going to think about the bespoke bipower variation, highlighted here in red, and a time of day version for bipower variation. So these weights come from the cross-day average of the product of these two terms here. So same idea, but slightly different construction as the time of day for realized variance. Another extension of the HAR model is one that I published with Kevin Shepherd back in 2015. This is where we decomposed volatility into upside and downside components. This is so-called realized semivariants. These were proposed by Barnov, Nielsen, Kinnerbrook, and Shepherd. So Barnov, Nielsen, Shepherd's all over this literature. They proposed estimating upside volatility as simply the sum of squared returns multiplied by an indicator for that return being positive, and then same for negative. And in that paper with Kevin, what we found is that applying this decomposition works best from a forecasting perspective if you only do it on the daily lag. At the monthly lag, we're just going to use standard realized variance because the decomposition didn't turn out to help much or at all there, but it did help in the daily lag. And so then we consider bespoke semivariances. So we have, in this case here, the squared return multiplied by the indicator with its own weight, and then the time of day version of this thing as well. In fact, I'm making a mistake here. So that should have an indicator also there. And these are the weights that we get out. So on the left-hand side, I'm showing you the continuous HAR, which is a flat line, and the bespoke continuous HAR, which is this red line. Same sort of pattern as we were seeing for the standard HAR. On the right-hand side, I'm showing you this semi-HAR, the semi-variance-based HAR model. Here we have two lines that we have to talk about because we've got the positive and the negative part. So let me first talk about the two flat lines. The higher of the two is the weight in the semi-HAR associated with negative variance. So this is what Kevin and I found almost a decade ago, that the lagged negative variance was more important for prediction than the lagged positive variance. We didn't have a good theory for it, but it was very, very strong in the data. And that's what we're seeing with this. This coefficient here is about 0.6. The coefficient on the positive variance is about 0.3. When we allow the weights inside each of those two semivariances to be flexibly estimated, we get this dotted line and the dashed line. Basically, we get the same pattern as before, but with a shift. So they both downweight the morning and upweight the afternoon, but the negative returns are more important for forecasting than the positive returns. And so here I'm showing you the baseline version of the model versus the bespoke version. The continuous HAR significantly, the bespoke version significantly beats the baseline for the continuous HAR and similar for the semi-HAR. And I thought the table I had was also TOD versus bespoke, but I guess I don't have that in the slide. So it's also the case that we beat time of day version of this model as well. Okay, and then the last thing I want to show you before I wrap up, I know it's been a lot of empirical results, but I want to show you one more thing. And this is sort of the good news after all this heavy computing that we did in the paper. I presented this slide somewhere and someone cheeky in the audience asked, could you just replace that red line with a straight line? Could you, this looks almost like you just draw a line from here to here. Okay, there's a few wiggles in there, but do you really need all of the flexibility that we have from this cubic HAR estimated with stochastic gradient ascent and all this fancy stuff? So we set out to answer the question, and the answer turns out to be good news for people who actually want to do this on their laptop rather than on a cluster computer. So what we're going to do, we're going to do a little bit more than just a straight line. We're going to do a cubic. So what we're going to have here is a parametric bespoke realized variance where we weight the squared returns using a cubic function of the counter for which period it is. So 1, 2, 3. Well, the powers are 1, 2, 3. The indicators go from 1 to 78. So the leading term is the constant, gamma naught. Then we have a linear type term, a quadratic, and a cubic term. So if I go back for a second, what I'm going to do is try to approximate this red line with a cubic function for an indicator for what period of the day it is, 1 to 78. when you take this first equation here, you can expand it into 4 summations. The gammas come outside the summation sign, and you end up with, in the first case, gamma naught times the sum of squared returns. That's just standard realized variance. No tricks, this is the old stuff. Gamma 1 times the counter for which period you're in times the squared return in that period. So I'm going to call that realized variance linear with linear weights. And I'm pointing like it's going from low to high. That would be true if gamma 1 was positive. It could have gone the other way. Then we have quadratic weights and cubic weights. What's interesting about this way to approach the problem is that each one of these 4 things can be computed before you get to the estimation step. These are just weighted sums of squared returns. No estimation needed. So almost free once you have the data. These are very cheap to compute. Then what one can do is, rather than do this sort of cubic bespoke RV on the first lag, you can swap it for this parametric approximation. And so what you end up doing is introducing 3 new terms to the baseline HAR. So we're in this, what I'm going to show you in a second, we're not doing it for the weekly and monthly because the shapes that we were getting there looked roughly flat. So we're going to leave those alone. But what we're going to do is just think about how we construct the best one-day lag of realized variance. And in this way, we have the usual one-day lag plus these 3 extra terms. So this is a linear model, only 7 parameters, no need for fancy computing power or fancy estimation methods, almost no need for regularization. It's only 7. You can just do it and run. So what we did, we don't regularize this model. It's not big enough to really warrant it, though maybe it would do better if we did. These are the shapes that we get out. So we considered the linear, the quadratic, and the cubic versions of these models. The linear and the quadratic are the red and green dashed line. They're almost on top of each other because the quadratic doesn't matter until the cubic kicks in. This is the straight line. So this is what this person asked when he's looking at the red line, saying, could you just draw a straight line through it? This is what you get when you get the straight line. The blue is almost the same as those two, though it tapers a little bit more in the morning. So you get slightly different shapes out, and you get less of a kick in the afternoon. But this is what we get averaging across these stocks. And now we look at their performance. So I'm taking as our baseline model here, this parametric approximation to our flexible model. So this is the 7-parameter HAR model, very cheap to estimate. It significantly beats the HAR model. So this de Beaumont test statistic is -25. It's a slightly bigger model, 3 extra parameters, but does much, much better. It also beats the cubic HAR model. So it doesn't beat it on the head-to-head. So it's slightly fewer wins, but it beats it when you aggregate across all. So there must be that some of those wins it has are big. So the big losses, big improvements in out-of-sample loss. And the overall t-stat is -3. So this is still very significant at any conventional level. So this parametric model beats this fancy machine learning type estimation method, and you can do it on your laptop in 0 time. It turns out, despite that picture looking rather similar, the cubic is slightly better than the linear and quadratic version. So there's something going on that it wants a little bit of shape in there. It beats those two. But the main thing I would say is this line here, that this parametric approximation to our flexible model is even better than the flexible model itself. So perhaps this structure, putting this structure on the problem, is helping in the out-of-sample forecast. So one of the things when I first saw this result, what I was hoping, what I was expecting was, we have this parametric approximation to our fancy method. I was expecting it to do almost as well, but not quite as well. And then the future researcher has a trade-off to consider. Do they want to do the heavy computing to get a slightly better forecast, or take the cheap and easy parametric approximation and get a slightly worse forecast? At least in our sample, there's no such trade-off to be had. You can do the cheap and easy model and get slightly better forecast than the fancy flexible model. The way I'm interpreting it, the positive spin that I would put on this slide is that because we have done the flexible, difficult to estimate model, whatever shape came out of the data, we could have observed. So the cubic approximation, the cubic spline can capture whatever shapes come out. It turns out that the shape that comes out is relatively simple, and so it's kind of easy to approximate parametrically. So ex post, we have this nice result that whatever could have come out, we would have detected. it turns out it doesn't have to be so flexible. And so a simple parametric approximation turns out to be even better than the flexible one. Okay, so let me finish. So our proposal is to tailor the realized variance measure, taking into account the information that we have when we know we're going to use it in a specific forecasting model with a specific target variable, specific forecast horizon. So we know that information as a forecaster, all that stuff is known. So what we're doing is going a step back to the construction of the volatility measure to take into account that information when we build the model. So these are what we're calling bespoke realized variances. We show how to estimate them using, by now, sort of standard machine learning methods. When we apply it to this big sample of US equity returns, we see lots of evidence that they significantly beat the standard methods, including a fancier method using time of day weights. And then it turns out, so that last slide I just showed you, that the optimal model is easy to approximate parametrically and very quick to estimate. And the explanation for why these forecasts do better, one is that it captures the information in yesterday afternoon's returns relative to yesterday morning. It allows for that information to get excess weight in the forecasting model relative to the flat weights. And it also allows for more weight on more recent information. Okay, and that's where I'll stop.
Amazing. Thanks so much, Andrew. That was a wonderful talk. Let me first give the floor to Nikolaus to ask some questions, and then I'll open the floor to everybody else. Nikolaus.
All right. So thank you very much, Andrew. I mean, it's a very interesting paper. It's a very nice paper. I have a few comments and also a few questions.
Should I start sharing my screen? Do you want to show anything, Nikolaus?
Well, I don't show anything, so, but I don't know. I mean, you can stop screen sharing. Yeah. So the topic is very interesting. So can machine learning beat classical time series analysis? The paper is a little bit in this spirit. So the question, how can we better learn from data? What I like is that this is not the usual horse race study on volatility prediction, where we have tons of papers in the literature where people throw in any kind of additional information in order to improve the forecast. Here it's about understanding whether we can better learn from the data. The data here is more or less, it's just the return series. It's the daily returns and the intraday, so the 5-minute return series. What I like is, and Andrew also stressed this, that it really opened the black box a bit behind machine learning. So why is something working or not working? So really drilling in quite deeply is very important. To me, this was also, or it still is, a very relevant question. I mean, we have successful time series models in the literature for ages. And also your results, Andrew, go a little bit in this direction. I mean, these time series models are typically very successful if they are able to pick up the structure in an appropriate way. And then it becomes very hard for a machine learning approach to outperform that. So in this spirit, it's a very interesting paper. I have a few questions here also in this spirit. So first of all, I'm still wondering a little bit, so what actually makes the RV a bespoke RV? Isn't it just a better volatility estimate, or at the end, it's just a better volatility forecast? I mean, what's the difference? In particular, at the end of your talk, I mean, it was not so much about machine learning anymore. I mean, machine learning was wiped out, essentially. I will come to that. And it was about, well, appropriately exploiting information from high frequency returns on the day before, more or less. And but isn't that somehow, of course, we didn't do this in the literature in that particular form, but it's very much in the spirit of traditional time series forecasting. It's just a minor comment. It's just about this naming now what makes bespoke RV. So how do we define a bespoke RV to a non-bespoke RV? And what means tailoring here? I mean, at the end, I mean, you forecast RV on the next day. Also in the objective function, the optimization procedure, you just do it in a very classical way. It's about minimizing some loss functions, doing this, of course, by training and then validating hyperparameters and then in an out-of-sample framework. Also, that is in some sense very classical. So I still wonder what now is new in this approach. This is not a critique. It's just about this. Don't get me wrong. It's just about this labeling, bespoke RV. I think we have a lot of bespokes RV already in the literature, maybe. So ultimately, it's about exploiting high-frequency information in an RV setup. And particularly at the end of your talk, it reminded me more. It was not so much about machine learning anymore. It was a little bit about, of course, this is fully parametrics, what you're doing here. But of course, you went. I mean, non-parametrics at the end is also something you can be considered as something as super parametrics. I mean, at the end, you did something what we also classically do. We try to learn from the structure in the data. This can be done via machine learning. It can be also done via non-parametrics. So we learn about certain relationships, some curves in the data, and then we try to capture this by simple parametric form at the end with a few parameters. That's what you did, and this works quite. This is quite successful. In this sense, that's very nice. So just coming back to now this notion of tailoring the model, because this is how the paper started. Now tailoring the model towards the specific application. So can we think about other examples, other applications where we now would get another bespoke RV? That would be very cool, because in this setup, I'm not so much surprised that you get out what you get out, because this is very classical forecasting. And also here, it's not very too surprising to me that particularly the information on the afternoon of the day before, in particular, if we leave out the overnight returns, then this is the most recent information that this gets the highest weight. I mean, it comes out super nicely in your analysis, and it's super impressive to see in how important this information is. But it's very much expected. So now I wonder, okay, other applications of RV apart from forecasting? Well, I don't know, maybe about hedging or a portfolio optimization or something different. So would we expect another bespoke RV setup? In the moment, I cannot imagine. I mean, I would do the same. Now, if I would need to run a hedging strategy, I need a good volatility forecast. I would take your model. So the question to me is, in which sense now is this really tailored towards a specific application? No, just as I just stressed, though, the importance of these afternoon returns, I mean, it makes a lot of sense. That's very intuitive. You mentioned that you take out the overnight returns. I understand that. Nevertheless, of course, it will be very interesting to see what happens if you take in the overnight returns. The question, do overnight returns wipe out this afternoon information? So then maybe all information is in the overnight returns, right? If we would just follow the logic, we take the most recent information in our data. So that would be interesting to see. But of course, there would be a little, it would change a little bit I see that it would change the story of the paper, but would be interesting. So one thing I'm really wondering is now coming back to the machine learning. So why is the fully flexible model not able to appropriately learn the weights? I mean, you mentioned that you struggled hard to get it to run, and well, I so now from my own work on that with my co-workers, so we also learned how hard that is. But in principle, I mean, you have lots of data, you have lots of assets, you have a long time series history. So in principle, it should be possible to learn this structure from the data. So I really wonder, and that's a little bit our own experience. So I wonder whether it might be also due to the optimization procedure. What we learned, and that's what we did, and I don't want to promote our own research, but this was just our experience, that the optimization procedure, it matters a lot. First of all, so how do you optimize, and which is the loss function, and how do you design these hyperparameters? And this really can change the results a lot. So it could be the case that in your context, maybe something is not optimal in this optimization procedure. In particular, I wonder if you would initialize your, I guess you did that. If you initialize, so the fully flexible model, you start from the basic HAR model. Then we would expect that at least you're as good as the basic HAR model, because your fully flexible model is more flexible than that. So the basic HAR model is nested. So you could start with the basic HAR model. So obviously you significantly underperform, if I understand correctly, the basic HAR model, which means that obviously in this optimization, you're moving in the complete wrong direction. So you obviously you do not hit the minimum of your loss function. So maybe it would be good, and I would be quite interesting, just if you really want to stress this idea. I don't know whether this is then still the key idea of the paper, but if you really want to learn to see whether machine learning is able to outperform the classical time series approaches, I think it would be really worth digging into these problems. So why does it work so badly? And in this context, I also was surprised why the regularized models perform so poorly. I mean, the lasso, and you did all the usual machinery. Also here, I mean, in principle, you also could start with with imposing the basic structure and then starting from that. Obviously, also here they walk in the wrong direction. So that's I mean, these are my thoughts. A little remark at the end. I was noting during your talk, you were talking, or you tried to stress a little bit the analogy to supervised and non-supervised learning. I found this a bit difficult, but maybe I misunderstand. So because RV itself is an estimate, and it's not a model. So we take the estimate and then we put it into the model. But here the analogy to supervised and non-supervised learning is a bit hard anyway, because we cannot observe volatility anyway. And so here, but this is just a remark where I was a little bit struggling to understand this analogy. Yeah, these are basically my questions and my comments. But I really like the paper. I mean, it's super nice. It's really impressive and that's what I really like. I mean, it's at the end, it's very simple, but you had to work very hard to get out a very simple model. Yeah, but that's exactly what it is. So we really get something which is easy to apply, which is very powerful. So like the original RV. So yeah, that's great.
Thank you very much, Nikolaus. Like, these are good things to think about, and some of it is terminology, which I am sympathetic to. I guess going backwards from the supervised, unsupervised sort of analogy, the way I was thinking of it, and it's only an analogy, it's not like a serious statement, is that when we think about, say, the HAR model, and we've got these 1,600 things on the right-hand side, where what I was thinking in that terminology was we're trying to do some dimension reduction of the right-hand side method. And RV can be thought of as a dimension reduction method where you simply sum lumps of these 5-minute squared returns into chunks, which then get their own free parameter. So in that sense, standard RV is unsupervised in the sense it just does some 78 blocks of 78 returns. And that gives you daily realized variance. The supervised version is where you optimally sum. So you take a weighted sum where the weights are supervised by the target variable in the forecasting model, that type of thing. But that's the extent to which I was thinking about supervised, unsupervised. I guess so I'll go backwards through your questions on why doesn't the fully flexible work better? So yes, I can only say we tried, but that doesn't mean we didn't try everything that could possibly have been done. We did use so we had 10 starting values to initialize the estimation method. One of them was the baseline HAR. So we used that as one of them. And then 9, we did sort of random starting values, and then we pooled the final answer. Our intuition for why it did worse than baseline HAR was that it starts from there, but then it overfits in sample because it's such a flexible model. So it's just fitting the noise. And then we try to tame that through the tuning parameters of the estimation method, but we don't shrink it all the way to 0. And so we end up overfitting that noise in sample, and that's leading to worse forecasts out of sample. But I agree with you that it is totally possible that tomorrow someone could come in and estimate that exact same model with a better method, and it beats the baseline HAR. I'm waiting for that to happen. So it didn't happen for us. We tried. One of the things that your comment made me think, though, is something that we didn't do, which was that fully flexible model with the 1,600 parameters was estimated stock by stock. So we'd have a long time series, but we weren't exploiting in any of these estimation methods the cross section. Like, these are all US equities, all kind of large. They're all in the SP 500. You could imagine doing this in sort of a pooled fashion where the weights are estimated pooling across stocks, and then we do some localization stock by stock on the HAR parameters, say. Like, that would give us 886 times more data to use. And that maybe is enough to get things working. But we didn't try that. But that your comments made me think that that's maybe a fruitful place to start. And I guess what is bespoke RV and where could it be used? So our idea for what makes a bespoke RV bespoke is that it's essentially just recognizing that in HAR models and GARCH-X models, and also in other models, we sometimes use variables that have been constructed from more granular data. So like RV is constructed from 5-minute returns. I gave this talk at a more macro econometric conference, and I was prompted to think about macro applications of this. And so the examples that come up in macro would be models where we're plugging in measures of, say, consumer price index measures, inflation measures, which are constructed from bundles of goods with particular weights given by some government agency. But from a forecasting perspective, those weights don't have to be the optimal weights. Same as for RV, the efficient weight is in classic is the equal weights. That's the classic measure. But for forecasting, we're showing that that's not the optimal way to weight. And in macro applications, you could imagine any of these constructed indices that we're plugging into vector order regressions. We could make them bespoke to that forecasting problem by reweighting the raw ingredients to better to target the forecasting problem they're being used in. So that's the extent to which I'm thinking about Bespoke. And then other applications for realized variance in particular. So we toyed a little bit with making realized variance, so Bespoke realized variance for portfolio decisions, for example. So what we're doing here is just pure forecasting. So we're tailoring it to the objective function is Q-like and the forecast horizon is 1 to 5 days. You could think about, what if I know I'm going to be constructing a minimum variance portfolio? That's the economic application. Can I make the realized variance bespoke to that problem? So we got some way to addressing that. Where we hit a wall was the same place that others have hit a wall 20 years ago, which was estimating volatility models through out of sample utility from a portfolio decision only poorly identifies the parameters of the volatility model. So the objective function is kind of flat in some of those models. So even though it's the right objective function to use, if that's the eventual application, statistically, it just doesn't have enough curvature to identify those parameters. And so you end up being better off estimating it using something like Q-like, which is the wrong objective function if that's your ultimate goal, but it's just a better objective function for estimation. So the bias variance type trade-off kicks in. It's got much lower variance, even though the parameters, if the model's misspecified, might be biased compared to. And so that, when we hit that wall, I was reminded of some work by Spiros Skouros that was building on stuff by Clive Granger. This is all sort of 90s and noughts. And we were just finding a harder version of that, where we have more parameters that are poorly identified from this economic objective function. But the idea is there, so it's possible. But for here, we focus just on the forecasting problem. But thank you for all the comments, Nikolaus. This was very helpful. Great.
Amazing. Thanks so much, Bo. So let me stop the recording here. And